Welcome to the 14th episode of the Sydney Contrarian, titled Why Invest in Gold, Silver and Mining Stocks in the Everything Bubble Market. This episode is a collection of economic and financial episodes I've done in the past that will now build my opinions on how one should invest going forward. I believe we are at the stage where my viewers have a clearer understanding of what is really happening in our world, and that the conventional method of thinking or collecting information from the mainstream media, which is also quite lame, so lamestream media, and government agencies is not prudent. To begin, let me reiterate that the state of the financial markets and the global markets is not actually precedented. We've seen just last Friday the Dow Jones Index falling 665.75 points, making it the third largest decline in absolute terms in history, but the percentage drop is actually hardly worth mentioning, being only 2.54%. This is because the Dow Jones Index has been on a tear from a bottom of around 6,500 at the beginning of March 2009 to as high as 26,600. The index in fact has quadrupled over the past 9 years, which is unbelievable. As this video goes on air, the ASX index is down around 80 points in response to the slump in the Dow Jones last Friday, but it's still only a small 1.3%. Will the market move down further, or is this another temporary dip? We are not sure. But what is important is that one should note, and as Mike Maloney has pointed out, he calls this current market the everything bubble. This is aptly named because virtually every key asset market is now trading at price levels that are considered theoretically excessive when one considers the underlying earning potential of such assets in the future. We are going to investigate this everything bubble in the Australian market context, and in the interest of time, I'm going to focus more on ASX stocks, Sydney property, precious metals, and Bitcoin. Of course, this is not the most comprehensive coverage, but I believe the point I make still stands even if we extend this analysis. I also want to make the caveat that my analysis is based on market movements up to the end of 2017. Conditions have changed somewhat, but especially with cryptocurrencies. However, my narrative should not be too different. If you look at the ASX stocks, Sydney property, gold, silver and Bitcoin and their performance over the past 5 years, we can see that Bitcoin virtually went on a tear and left the other assets in the wilderness, given its 13-fold rise over the 2017 calendar year. Such was the outperformance that I had to use a log scale to meaningfully show their comparative returns over this period. Indeed, Bitcoin and other cryptocurrencies can be defined as a new asset class and would deserve a more in-depth discussion. However, I'll relegate this to a future episode. If we put it away Bitcoin and compare the other four assets in the lower chart, you can see that the returns are more comparable, as in the four assets are moving in a range that is more that's easier to see. Equities delivered a solid return of 62% over the past 5 years, outperforming Sydney properties that witnessed a reversing trend since the middle of 2017, delivering 41% over the same period. Gold barely delivered a gain in the past 5 years, while silver investors would have lost over 25% in their investment. However, context needs to be considered in this case study. Equities and property prices rose steadily over this period in conjunction with the Federal Reserve, then headed by Ben Bernanke, who decided to attempt one last experiment in monetary policy to bring back inflation into the economy. This he achieved by undertaking the third round of printing currency by buying up virtually an unlimited amount of bad debt from banks and financial institutions. At the same time, these banks would be able to go and lend a huge amount of currency to the market for people to speculate, and the Wall Street banks were trading in precious metal contracts, paper contracts, to keep gold and silver prices down in order to make it look like the economy is improving and that there is less need to hedge one's risk or reduce one's risk by buying gold or silver. In April 2013, gold actually fell over $200 in the space of a fortnight, which basically scared the living daylights out of gold and silver investors and completely destroyed their appetite on investing in these assets for quite a while. From there, the bull market on precious metals that began in 2004 effectively ended, and investors focused their attention on financial assets rather than precious metals. Now let's look at the equities market. As you would have seen on the news about the ASX 200 index finally breaching the 6,000 level at the end of 2017, the last time we saw this was around 10 years ago in the midst of the subprime crisis. We almost got there in May 2015, falling 5 points short. Needless to say, the mainstream media pundits are getting excited, hoping to use this psychological level as an indicator that we are back in the good old days. If only it was that simple, or even naive. The inconvenient truth is that the ASX equities are actually not doing as well as the index level leads you to believe. The index is a market capitalization weighted index, meaning the largest companies have the greatest impact on the index movements. So you can have a rising index due to the largest few companies increasing in price, while the remaining hundreds of companies that form the index that are smaller are in fact falling in price. This is more the case with the US stock market, where the Dow Jones and the S&P 500 indices broke a record over some 70 trading days in 2017. This was basically sparked by fund managers and the central bank buying the largest companies to keep the index going up. If you look at the top 20 stocks in the ASX, 12 of them are actually trading at less than 80% of their all-time peak, and 13 of the 20 companies had peaked before 2016. And I did a personal analysis of this. You can go and do the same by going and getting the stock price history and trying it out. If you recall in my previous episode, I have shown that the big four banks have been trending downwards since their peak in April-May 2015. And this is despite the RBA reducing interest rates to a record low of 1.5% since late 2016. By reducing the interest rate to a record low, banks should have increased their profit margins by reducing savings deposits, by quietly raising mortgage rates on foreign investor and interest-only mortgage loans. You may argue that the fact that most of the top 20 companies are not trading at peak prices may show that they are reflecting better value, but this is to be taken in context of individual stock price trends and their profitability. And if you go into a shopping mall, you'll realize that there are less customers and more in-store specials. And in my previous episode, I have discussed that the inflation on necessities and the weaker income growth is putting a restraint on economic growth arising from consumption and investment. In short, using the ASX index as a proxy for measuring equity market performance overall is unwise. It can smooth over much weakness in the economy and its many components. We will again review the RBA interest rate and also the 3-year Australian government bond yields. As we can see, the RBA has followed the Federal Reserve in implementing a highly accommodative monetary policy over the recent period. Unlike the Federal Reserve, the RBA has not raised interest rates since 2011, and it is rumoured that they may not want to do so this year, although I believe the property market will put pressure on the RBA from doing this. Of greater interest is the 3-year government bond yield. The recent 6 months have seen this yield heading upwards, showing that bond investors are selling out and perhaps moving into other risky assets. The last time this happened was in 2014, whereby the RBA went against the market and cut interest rates. This of course spurred even greater price rises in the equities and property markets, which is now significantly overvalued. So the RBA is faced with a catch-22 situation. They can keep interest rates at record low, or even try to cut it to try to encourage more borrowing and spending, but this may push investors further into buying equities, properties, and other risky assets that are priced already at levels that concern the RBA Board of Governors. Or they can try to cool the asset market bubbles by raising the interest rate to rein in on speculation and excessive borrowing. However, this is as safe as smoking next to a gas pipe. For one, I would not wish upon anyone to be in the position of the RBA Board of Governors in this day and age. I believe that investing wisely requires one to adopt a contrarian perspective. To be a contrarian requires courage and discernment. Courage allows you to act on your conviction even if it goes against consensus, and you may even be sacrificing security and stability. Discernment allows you to exercise wise judgment in making your decisions and reviewing your decisions in changing circumstances. Without courage, you'll unlikely take a stance that exposes you to being the minority. Without discernment, you are merely exposing yourself to risk and dangers that may overwhelm you. So I'll cut to the chase. I put gold and silver in comparison to stocks, properties, and Bitcoin because I want to highlight how these two commodities have been languishing in the past 5 years. If you look more closely at their price trend since late 2015, they are showing signs of recovery and possibly entering into a bull market. Now, I expect some people will say that gold and silver were in their own respective bubbles that peaked in 2011, and some of you may even have been burnt badly having invested in them over these past 7 years. I too have suffered, but I had already more than compensated for my losses up to 2014. And I can safely say that the rally is only beginning. The common misnomer is to consider gold and silver prices in US dollar terms, which is what is reported in the media, even in Australia. But I believe that it is wise, especially if you live in Australia, that we price gold and silver in our local currency. And secondly, the reason why I think the misnomer exists is that the US dollar is not stable and its value can change relative to other major currencies depending on the relative strength of the different economies. The US dollar index is a proxy measure of the US dollar's value against 6 major currencies. And if you use this, you can actually make more sense of how gold and silver prices have been moving over this period. The US dollar index would strengthen if the US economy becomes stronger relative to the other major economies that the US dollar index forms. And when the US economy becomes stronger, then the US dollar is demanded by the market more, and therefore gold and silver price will similarly rise in value if we hold all other factors constant. Now, the recovery of the US dollar over 2013 to 2017 did cause the gold and silver prices to drop, and that's actually what the mainstream media focuses on. But despite this, they have both gained ground since late 2014, which is not really mentioned by the mainstream media. If you look at the green lines in both the figures, they will show that the approximate value of gold and silver after adjusting for the US dollar index. This would be a better index to look at. While gold peaked in September 2011, the current gold price is actually only 10% lower than the peak price, despite it being 2/3 of its peak price in nominal terms. And silver, well, it's 58% lower than what it was when it peaked, compared to 70% lower in nominal terms. So it's important to understand the actual value of commodities, which is priced in US dollar terms, and once you have, you'll not be easily misled into taking the same perspective that the mainstream media wants you to take. Looking at the performance of gold and silver in Australian dollar terms over the past 15 years, you may now see better why much merit exists in investing in gold and silver. The seemingly unusual and bubbly move of both gold and silver into 2011 may lead you to think that it is too risky. However, the same could be said about all other assets, including government bonds and properties, if you look at their price trends. Now, if you had invested $100 in gold and silver in January 2003, your holdings today would be worth $275 in gold, and silver would be about $260. That's not too bad. But along the way, gold almost headed up to $300, while silver exceeded $550. Now, I understand when people say that the path of watching your wealth go down between 2011 to now would be quite horrific, especially with silver where you lost almost half your wealth. But remember this, the prices of gold and silver have been more steady in the past 2 to 3 years, compared to if you look at the other assets as I talked about, where they've been going up very significantly and very consistently over the past 8 to 9 years without much pause or reduce it or a decline. Now, what I would like to also point out is that it does feel like you are buying an unattractive asset, whereas if you invested in the other assets, they're steadily rising in price levels in the period of between 2013 to 2017. It feels like driving in a slow lane in a Toyota Corolla while watching people speed past you in the exotic sports cars. Now, herein lies the contrarian view on investing. Now that the market has become so overvalued and exuberant because of virtually all assets rising in price and showing little signs of declining, astute investors should be heading to what little is left in the not so overvalued basket of assets. As in, they should be anticipating where the crowd is going to rush to when all the other assets that they're investing in that are overvalued start to show a decline. And as you have seen, especially in the past month, cryptocurrencies, especially say Bitcoin, they've dropped as much as 60% in price. And where are these people's assets going to go? Now, profits can be made by following the crowd, as many do, though many who trade on momentum this way eventually get taken to cleaners because the momentum will break and they're caught in a stampede out of the crowded space. They are usually not going to be able to get ahead of the crowd, and therefore when everyone heads for the exit, they're also going to be late in coming. The other place to be making profits is to identify where many will go to after they panic out of other assets. And in fact, the smart money, which are those in financial institutions, successful fund managers, and those who get invited to talk on mainstream TV to talk about what they're investing in, and we follow their advice, which makes them successful, they're the ones they actually get out of the party before it's over and create the next party. And I suspect the next party will be back in commodities, especially in precious metals such as gold and silver. To add, remember that precious metals cannot be printed and created by humans. They need to be mined, and there is limited supply. There is a faster growth in currencies being printed than precious metals being mined out of the ground. The only reason for prices not moving is because paper contracts have been used to control the prices right now. To find out more about what this means and how it works, I advise you to watch Mike Maloney's The Hidden Secrets of Money. There are currently 8 episodes, and I believe that it will be very valuable for you if you have not already watched it. Now, in future episodes, I will delve further into precious metal investing and also looking at gold and silver mining companies, which I have identified as a possible pathway to capitalizing on the upcoming market movements. It is greater risk, and it requires more effort to look into it, but I believe that it is worth reconsidering how you invest your wealth and ensure that you do not get caught up in the potential market panic as the global financial system weakens further. Well, that's it from the Sydney Contrarian. Stay tuned for a future episode, and once again, God bless.